ever imagined launching the perfect business only to watch it crumble because of small, overlooked details? Hello, and welcome to Money Craft Masters. Launching an LLC is a dream for many, offering flexibility, protection, and a professional status. But beware, because even the most minor mistakes can have significant consequences. Today, we're exploring the critical missteps to sidestep as you embark on your LLC journey. Before we delve into these essential tips, remember to hit like, share, and subscribe, ensuring you're always ahead in your business game. As we navigate the labyrinth of entrepreneurship, how to structure a business becomes pivotal. Historically, businesses were either sole proprietorships, partnerships, or corporations. Each had its benefits but came with significant drawbacks. Enter the limited liability company, or LLC, a relatively new kid on the block, having only been around since the late 1970s. An LLC ingeniously merges the best of both worlds: the personal liability protection of a corporation with the flexibility and tax advantages of a partnership. This structure has gained immense traction in the United States over the last few decades, becoming the go-to for many small to medium enterprises. But why? The answer is twofold. First, forming an LLC gives business owners a safety net, ensuring that personal assets aren't on the line if things go south. Secondly, the taxation benefits and operational flexibility make it an appealing option for businesses across many sectors. However, with this surge in popularity also comes a rise in missteps. The ease of setting up an LLC can sometimes create an illusion of simplicity. But don't be fooled. There are intricate details and nuances that, if overlooked, can lead to unfavorable consequences. Mistake 1. Not conducting a name search. Imagine pouring your heart and soul into building a brand, only to discover that the name you've chosen is already in use by another company. That's more than just a simple oops moment. It can be costly and legally messy. Yet this mistake is surprisingly common among budding entrepreneurs. A thorough name search isn't just about Google searches or domain availability checks. While those are indeed crucial first steps, the real test comes in verifying that your desired name is unique within the registry of your state's business entities. Every state maintains a database of registered business names, ensuring no two entities have identical or confusingly similar names. Skipping this step can result in legal disputes, the potential rebranding of your business, and even penalties. It's about more than just avoiding legal tangles. It's about carving a unique identity in the market that's distinctly yours and can't be mistaken for another. Remember, your business name is often your first impression on potential clients and partners. Ensuring its uniqueness safeguards you legally and sets the foundation for building a robust and distinguishable brand in your industry. Mistake 2. Ignoring operating agreements. Business, especially between friends or longtime associates, is smooth sailing. A handshake, mutual trust, and off you go. But when disagreements arise or unexpected situations hit, that trust can be put to the test. This is where the operating agreement comes into play, and neglecting it is a pitfall many new LLC owners unfortunately fall into. An operating agreement, in its essence, is the rulebook of your LLC. It outlines the roles of each member, the decision-making processes, how profits and losses are distributed, and, crucially, how disputes are to be resolved. Believing that such a document is unnecessary, especially for single-member LCs or among close-knit partners, is a misconception. As the business grows and evolves, there will inevitably be scenarios you hadn't anticipated. Perhaps a member wants to exit the company, or there needs to be more disagreement over the LLC's direction. With a clearly defined operating agreement, such situations can be smooth, prolonged, and beneficial to the business. Setting these guidelines from the outset is not about mistrust, but clarity, foresight, and ensuring all members are on the same page. An effective operating agreement streamlines operations and acts as a protective shield against potential internal conflict. Don't see it as mere paperwork. View it as the blueprint for a harmonious and prosperous business journey. Mistake 3. Forgetting annual reports and fees. Time flies, especially in the world of business. With countless daily tasks demanding an entrepreneur's attention daily, some crucial responsibilities might slip through the cracks. One oversight that can lead to grave consequences for LLCs is neglecting to file annual reports and paying associated fees. Every state has regulations, but most require LCS to submit annual or biennial report. This report typically provides updates on key information about the business, such as addresses, management structure, and business activities. But why is this so essential? These reports keep the state updated on your business's current operations, ensuring transparency and compliance with local regulations. Overlooking this obligation can result in penalties and, worse, the dissolution of your LLC. Imagine building a thriving business only to dissolve because of a missed report or unpaid fee. The good news: many states offer online portals, making the submission process straightforward and efficient. Setting regular reminders, using management software, or even hiring services to manage these filings can save you from unintentional lapses. Remember, keeping your LLC in good standing isn't just about flourishing operations. It's about maintaining compliance. The cost of rectifying an oversight is often much higher, both financially and in terms of time, than simply staying on top of these critical requirements. Think of this as a business exchange. If you feel the value we're providing is tipping the scales, help us balance it out. Give a like for the insights, subscribe for the strategies, and share to spread the wealth of knowledge. Mistake 4. Not separating personal and business finances. The thrill of making your first business sale or securing that initial client contract. But where does that money go? Into your account or a separate business account? Merging personal and business finances might seem convenient initially, but it's a recipe for confusion and potentially disaster. You blur the lines between your individual assets and your companies by not having distinct accounts for personal and business transactions. This poses several risks. Firstly, it can make bookkeeping a nightmare. Distinguishing between a personal expense and a business one becomes a tedious, error-prone task. But it's not just about ease of management. The primary allure of an LLC is the limited liability protection it offers. If your personal and business finances are intertwined, this protective wall can be challenged in legal disputes, putting your personal assets at risk. Starting off with separate bank accounts, dedicated credit cards, and distinct financial ledgers for your business ensures clarity. It simplifies tax preparations, enhances financial transparency, and, most importantly, upholds the protective barrier of your LLC. The bottom line? Treat your business like the separate entity it is. This distinction safeguards both your business's integrity and your personal financial well-being. Mistake 5. Neglecting proper tax planning. There's a saying, nothing is certain except death and taxes. And while taxes might not be the most exciting topic, they are crucial for every entrepreneur to understand, especially when running an LLC. All too often, new business owners dive headfirst into operations without giving tax planning the attention it truly deserves. One of the main attractions of an LLC is its tax flexibility. Depending on the state and structure, an LLC can be taxed as a sole proprietorship, partnership, or even a corporation. But this flexibility is a double-edged sword. Without proper planning, you might have unexpected tax liabilities or miss out on potential deductions. For instance, self-employment taxes can catch LLC members off guard. In contrast, corporations only tax profits, and self-employed LLC members might need to pay taxes on the entire net earnings of the business, which can be significantly higher. The solution: proactive tax planning. Early on, engaging with a knowledgeable accountant or tax professional can illuminate potential pitfalls and opportunities. They can advise on optimal tax structures, available deductions, and strategies to minimize your tax burden. Surprises are often welcome in business, but not when they come as unexpected tax bills. With a proactive approach to tax planning, you can ensure that you're compliant and optimizing your financial strategy to its fullest potential. From the significance of name searches and operating agreements to the vitality of tax planning and adequate insurance, each step is crucial in building a resilient, compliant, and prosperous business. Take this to heart for all aspiring entrepreneurs watching. Take this to heart. The road to entrepreneurship is filled with opportunities and pitfalls. But with the proper knowledge, foresight, and expert guidance, you can navigate this path confidently, turning potential mistakes into stepping stones for growth. To our dedicated viewers, Thank you for joining us on this insightful journey. As always, we're here to provide you with the tools and insights to thrive in the business world. Please like, share, and subscribe if you find this video valuable. And don't forget to hit that bell icon for more actionable advice. Until next time, keep innovating, learning, and striving for excellence. This is Money Craft Masters signing off.